All right, so we also promised to talk about volatility and investing, and we're going to do that now. Here's a little pop quiz, and you'll get to take a GoToMeeting survey to answer it. So let's say you are in a mode where you are saving on a regular basis and investing those savings immediately over the next 5 years. So as you save, you invest. So what kind of market is going to be the most advantageous to you? So your first choice is that the market steadily rises each year, goes up consistently, and by the end of the 5 years it is up 40% from where we started. Just a nice gentle ride with very low volatility. The next choice is a rockier ride. The market is very volatile and is both up and down over the 5 years. And when we get off the ride, the market is exactly at the same place as where we started. The last choice is even more volatile. The market is not only violently up and down over the 5 years, but by the time 5 years is over, we are below where we started and we are reaching for their sickness bag. So at this point, I'll turn it over to Lori so she can run our little poll.
Okay, I'm going to launch the poll. You can go ahead and pick one of those. Okay, well, we have about 84% of the people voted, so.
I think that's good. Let's take a look.
All right, I will close the poll, and then I will share the results.
So it looks like 56% said you liked option A, steadily and consistently going up. Second was option B, at 28% that liked the volatile but ended up at the same place. And a fairly small percentage, about 16%, picked option C. So, all right, so let's see what happens. We'll assume our investment of choice is SPY, the S&P 500 Index ETFs. First scenario is A. We see every year we invested $1,000, and because the price was going up evenly every year, 100, 110, 120, 130, 140, you can see we were actually buying fewer shares each year. We bought 10 in the first year, 9, then 8, a little under 8. By the end, we have 35 shares of SPY, and at our $140, that's 40% up from where we started. Our $4,000 investment is worth $4,914, a gain of just under 23%. Not bad. Now let's look at scenario B. We can see the index dropped off to 60 for a couple years and then jumped up to 140 and finally settled at $100. Same place as where we started, but our stomachs are queasy from the ride. However, because we had opportunities to buy at the really low price of 60 for a couple years, we actually ended up owning 50.5 shares of SPY, and they are now worth $5,048, a gain of 26.2%. That's even nicer. And the little extra money helped pay for our Pepto-Bismol for the ride. But here is one that is even more surprising. This is answer C, and this is real data. Every year in Tulsa, I would teach an evening class on index ETFs and SPY. If someone would have invested their $1,000 the next day after my class, they would have seen these prices and these share purchases. So in 07, the price was almost 147, actually about where we are today, and they would have bought just under 7 shares. But in 08, they had much lower prices and bought quite a few more shares. All told, they would have bought 39 shares, and the price at the end of the period was $131, over 10% below where we started in 2007. But check this out. Our $4,000 turned into $5,134, a 28% gain from price appreciation. And don't forget, all the while we were also collecting a dividend of about 2% per year. As you know, it has been hard to live through this, but if you were saving and investing, it would have paid off for you. Those who picked the third option deserve a gold star, or they may have been a student of mine in another class and have seen this example already. When we are regularly putting money into the market, volatility can be our friend. He lets us buy more shares when the price is low, and we buy fewer when the prices are high. Didn't some kind of investing guru say the key to investing in the stock market was buy low and sell high? Maybe his name was Mr. Volatility.